Hi! In this video, we will start from the structure we created in the last video and calculate cash flows, which are going to be the last piece of the puzzle and will allow us to complete the model we are building. Let's start from the top. We need to link EBITDA to the P&L sheet. Once we have done that, we can link taxes and interest expenses. Perfect. There is a mechanism that is very important for calculating cash flows. We need to consider all balance sheet items that changed during the financial period under consideration and adjust if there was a P&L effect deriving from such change. The logic for calculating cash movements of balance sheet items is the following. If an asset increased, there was a cash outflow. We paid money to buy the asset. If an asset decreased, there was a cash inflow. We received money for selling the asset. If a liability increased, there was a cash inflow. We took debt or financing. If a liability decreased, there was a cash outflow. We paid debt. This is a good logic explaining the rationale behind cash flow calculation. It will be very useful to remember it when you have to construct or analyze a cash flow statement. Let's start from the calculation of cash movements arising from the change of balance sheet items. Based on what we said, the formula for calculation of asset movements is minus this year's quantity minus last year's quantity. And here is the cash movement of trade receivables. This is an asset, and that is why I am putting a minus before the brackets and subtracting 2017 trade receivables minus 2016 trade receivables. Let's copy the same formula for the row below, as inventory stands below trade receivables in the balance sheet, and the same formula is applied to them, as they are an asset. Next, we have trade payables. They are a liability, and their increase generates cash. Hence, we would not put a minus sign in front of the formula, which calculates cash movements for liabilities. Their increase translates in a cash inflow. We are subtracting the amount of trade payables at the end of 2017 and the amount at the end of 2016. Next, we must calculate the cash movements of other assets and other liabilities. We'll respect the same logic as above. The other assets movement has a minus sign in front of it, given we are talking about an asset. The calculation of other liabilities would not have a minus sign in front. Every time we approach the movement of a balance sheet item in our cash flow, we need to think whether it is an asset or a liability. The next item is CapEx, or capital expenditures. They are capitalized costs and represent an asset, which the firm took on its balance sheet. We already calculated the CapEx in the forecast period. Let's link to the fixed asset roll forward sheet. Please note we have a negative sign here. Very well. This gives us the firm's operating cash flow. Let's sum all items above and calculate operating cash flow. Excellent. A few other items have to be considered. Dividends is in the equity schedule, so we can link it there. The cash impact of the change of financial liabilities can be seen in the financial liabilities sheet. Provisions can be easily calculated in the balance sheet. We modeled them as flat, and I'd expect a zero cash impact, which is correct. All right, the last item that must be considered is change in equity, other than dividend payments and net income, which have already been considered. To calculate the change in equity, we should take the difference between the equity in 2017 and the equity in 2016, and then subtract net income and dividend payments, given these have already been considered. And as expected, no changes of equity result from our calculation. Perfect! Now I can sum the rows above and obtain net cash flow. Let's go to the balance sheet and write the following formula. Last year's cash plus this year's net cash flow is equal to ending cash in 2017. See? The balance sheet balanced for 2017. Let's paste the formula to the right, and if we've worked correctly, the balance sheet must balance for the remaining years. Great, it did. This completes our model. We've created an integrated model with an income statement, balance sheet, and a cash flow. More importantly, we learned how to do it in Excel, applying advanced techniques we saw earlier in the course. And we shouldn't forget, we built a flexible model with 3 scenarios. If I change one of the scenarios in the P&L sheet, the numbers will change in the entire model, but the balance sheet will continue to balance. And that's how it should be. Thank you for staying with us until the end of this exercise. We hope you enjoyed it. We certainly did.